Let me bring in Dhirendra Kumar, the CEO of Value Research and the person who answers all of our mutual fund questions every week. Dhirendra, as always, it's a pleasure to have you on this show.
Thank you.
Let's get straight to our portfolio versus portfolio question. Well, this week, we're helping Colonel Mohan, who's 45 years old. He has an annual income of 10 lakh rupees. And his plan is to save for his 17-year-old daughter's education and for her wedding. I'm assuming he has between 4 to 8 years to make these savings. Now, he tells us he invests 10,000 rupees every month in a list of mutual funds that he's sent to us. He has Birla Sun Life Frontline Equity, Reliance Diversified Power Sector, HDFC Top 200, and he also has some lump sum investments. Dhirendra, from the look of his investments right now, it seems a little haphazard. He doesn't really have a very clear plan. He's putting some money in his Provident Fund as well. Do you think he needs to maybe relook at the way he's approaching his investments?
Depends. He requires a more holistic plan. He will have his Provident Fund, which is getting deducted. That is actually the fixed income allocation. So I think he should be looking at his finances holistically, assuming that he's able to he's unlikely to need the money for next 7 years. The plan for that will be very different. In that case, I would suggest that he should choose our stable growth portfolio, which is 65-70% equity, 30% fixed income, and carry on. It will be moderately and carry on for next 2-3 years, and after that move into the conservative portfolio. So that is the way to change track. If he's likely to need the money in 3 to 4 years' time for the education, I think he'll have to look. That is the kind of money which should not find way into equity at all.
But the other thing that worries me about Colonel Mohan's portfolio is that while he's putting money aside for his daughter right now, he has about 15,000 a month going into his Provident Fund. Do you think he should also be making some sort of equity allocation for his own retirement at the same point?
Most certainly, but it's very difficult. It's the mandatory deduction which actually finds its way into Provident Fund. So he should try and avoid making investment into Provident Fund if possible, beyond a point which will not entail him the tax break. These fixed income allocation, which we have been historically used to, and they provide the comfort of guaranteed return, because they provide you guaranteed return, because they provide you fixed return, they are not best placed to beat inflation. So I would say, understanding that principle, why you should be into equity and a long-term investment made into equity, you can tide over the cyclicality. Equity is very risky when you invest for a few days or few months or few years. But if you are investing for many years, I think the risk goes down substantially. The holding period actually reduces the risk, and you can withstand it much better because you will be building it gradually. So with this understanding only, with this belief only, one can move one's money or reduce one's allocation to Provident Fund and move into equity. Otherwise, it's very difficult for somebody who has only been used to a Provident Fund as a savings vehicle.
Right, and if you could recommend maybe one fund or two funds that he can use for that equity allocation for his own retirement, what would those be?
Choosing a diversified equity fund from our growth portfolio, that should be good enough, 1 or 2 fund, and that should do the job.
Right, Colonel Mohan, that's the advice you're getting. While you're making that plan for your daughter, you also need to start setting aside some money for yourself and for your retirement. Dhirendra, they're recommending a couple of funds you can use to save for your retirement along with your Provident Fund. Good luck with those investments. Let's move on now to our hold or sell segment. Well, 28-year-old Anuj Gupta has written in. He's invested 50 lakh rupees in his mutual fund portfolio. He wants to put aside another 50 lakh rupees over the next few years. Now, he sent us a list of his funds, Dhirendra, and he wants us to help him understand which of these funds he should continue investing in. The first on the list is a Reliance Equity Fund. Would you recommend he continue investing in this fund at this point?
No, this is an extremely disappointing fund. This is a large cap fund which has a mandate to benefit from a fall in the market by having a large position into by following a derivative strategy. It has not benefited from that particular flexibility it has, and on the other hand, for a large cap fund, it has been extremely disappointing relative to the alternatives investors have. It's a very clear sell. I think he has held it for too long.
4 out of 6 funds are from Reliance, so I'm going to take them together. He has Reliance Regular Savings Equity, which is a good performer, and he has Reliance Growth. Do you think he should continue investing in both of them?
No, I would say that Reliance Regular Savings Fund is a fairly diverse vehicle. It has been and the difference between this and the Reliance growth is that this has been more consistent, though it has limited history. And Reliance growth has been extremely disappointing in many years. It has not shown any the brilliance based on which the whole fund was built. For past 5-6 years, it has been a fairly, one can say an average or a below average fund. So he can move that money as well to Reliance regular savings equity fund.
All right, move all of those funds into Reliance regular savings equity. What about the Reliance diversified power sector fund? We just talked about this sort of exposure that's thematic and specific to a particular sector. And considering power has been doing well lately, would you recommend he books out of this fund? Yeah,
I think it will be a good time to get out of this fund and move into a diversified vehicle, simply because power was. This fund got devastated about 3 months back. It would have been psychologically very difficult for investors to get out of this fund.
Here's the principal emerging blue chip fund. Now, this is a mid-cap fund, and would you recommend he continue investing in this one?
Yes, this is not a very old fund, and it has been a reasonable mid-cap fund, but mid-caps generally has been out of favor. So judging based on its limited history may not be a good idea, and the times are looking to be good times ahead for the mid-caps, so wait for some more time.
And finally, DWS investment opportunity. Dhirendra, do you think he needs to continue putting some money in this fund?
No, this has been a below average fund over a long period of time. Till about 4 years back, it was an impressive fund, and since then it has not been able to make a mark with anything which can justify its position in a portfolio.
All right, Anuj. Dhirendra Kumar there, looking personally at your portfolio and telling you what you should continue investing in and what you should book out of at this point. Remember, if you'd want your portfolio looked at by Dhirendra, send in an email to the email ID that's at the bottom of your screen. We have a question that's coming from a very young investor. 22-year-old Vicky has written in. He tells us he has $1.5 lakh in savings right now. He wants to invest, and he wants to know what he should keep in mind when he's making that first mutual fund investment. Dhirendra, can you give him a checklist of what he should keep in mind when investing his money?
I would say that, have 3-4 rules for yourself forever, which is long-term money to be invested in equity. If you can choose stocks yourself, by all means, and which means that you have the time, inclination, go ahead and do it. It's a very interesting vocation. If you can't do that, choose a good equity fund. Try to choose an equity fund which is as diverse as possible, which has least of limitations, which means a flexi cap fund or a large and mid cap fund, which will give you exposure to all the segments of the market. Be regular and keep investing through the lean times. That is the time when your belief actually translates into superior performance. So pretty simple, very tough to do.
All right, Vicky, we hope you wrote that down. And for those of you watching who also can use that advice, remember Dhirendra said invest systematically. Don't go by tips if you're investing in equity. Make sure you have at least 5 years on your hands if you're entering the equity market right now. And of course, stay away from those sectoral funds.